always tell you there's no coulda, woulda, shoulda in this business, but it still gets me angry when I see a high-quality stock roaring after a great quarter, and we don't own it for the charitable trust. That's how I felt today as I watched Mondelez and Colgate rally after some very good reports. Now, beating yourself up for not owning every stock in a red-hot group like the consumer packaged goods industry is right now is a totally self-defeating attitude. See, we own Procter & Gamble for the trust, and it's been a real horse. So why kick yourself over not owning the very similar Colgate? At the end of the day, we run a diversified portfolio around here, and we preach that you can't own them all, because when one goes down, they're all going to go down. That's why you can only have so much exposure to any given industry, even though it hurts on days when they all go up, like today. Still, let's talk about the future, not the past. Can these food and consumer packaged goods stocks keep running? I know they're all household names. My answer is yes, unless we get some sort of exogenous news that drags down the entire market. Fortunately for this group, you may get a chance to buy them lower. Now, if you listen to politicians, as I do, who come on Squawk Box in the morning, you certainly believe that it might be very difficult to reach a debt ceiling deal, even as members of both parties always tell us after they attack each other not to worry. Call me worried. At least enough worried that it will come down to the 11th hour and the market will not like that kind of uncertainty. The two parties hate each other. They hate each other more than I've ever seen, frankly, which means you can expect plenty of drama. So as the debt ceiling talks flounder, I think this group, the packaged goods stocks, are the ones you want to buy. You definitely want to buy at least one of these, a cereal company, a snack company, dog food, whatever, because they've been through this crisis before. Not even that long ago. In 2011, we had a huge swoon to the market when it looked like the government would run out of money. While the Democrats in the White House ultimately cut a deal with the Republicans in Congress, the S&P 500 fell 19% peak to trough for the compromise. And the S&P even downgraded our government's debt. Oh, that was an ugly day. If that happens again, you will get your chance to buy Mondelez and Colgate. Throw in Hershey and General Mills and Procter & Gamble, too. Why these? Because they've proven to be remarkably inelastic. As we told Investing Club members this week, people always take comfort in their favorite brands. Brands like Oreos or Colgate, Hershey bars, Campbell's soup. We learned that during the COVID era, and it's continued into this uncertain time. People aren't abandoning these brands despite gigantic price hikes put through because of COVID-generated shortages of all sorts of businesses. It's really pretty incredible. And it's defied many of the analysts who thought consumers would balk. They haven't, which is fabulous for the stocks because the analysts got it wrong. The pandemic wreaked havoc on the production of all sorts of packaged goods. Supply chains were ripped asunder. Materials soared in prices, especially paper and plastic for packaging. These companies all got crushed on costs, so they started putting through the price increases after price increases that you saw at the supermarket. And the amazing thing, there's been almost no resistance from the consumer. They love their brands during COVID. They trust those brands now. They're going to love them in the future, even if the prices have gone up so much. It's amazing. What makes these stocks incredibly compelling right now is that the high prices, I believe, are here to stay. But their costs, what it takes to produce what you buy at the supermarket, are finally coming down. Supply chain woes have been solved. Freight costs have collapsed. But they're certainly not passing on those savings to their consumer base, are they? I mean, these businesses are businesses. They're not charities. Have you seen any prices come down? I haven't. Next to fall will be the raw costs, which are already down huge in what's known as the spot market: paper, linerboard, plastic. Problem is, most packaged goods companies buy these materials by contract each year, so they haven't seen much savings so far. But when they sign the new contracts, they're all the prices are rolling over, they'll be paying a lot less than they did before. This quarter, we saw that the price increases have more than covered these companies' costs. Going forward, we'll see what happens when the costs get rolled back while the final prices stay just as high. There'll be incredible margin expansion. They'll make much more money per candy bar, leading to tremendous earnings growth. That's why even as these consumer packaged goods stocks have run a great deal, I don't think it's too late. I think they can continue to beat and raise numbers for some time to come. And that is indeed the holy grail for professional money managers. They can't resist this kind of setup. These stocks are perfect buys for when everyone runs from the market because of its coming debt ceiling debacle. So get ready. Pick your fave of these. I'm going with Procter. And let's try to profit from the federal carnage. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. See you Monday. Last call starts now.